And welcome to the European Parliament in Brussels for Talking Europe. Is the EU serious about fighting tax avoidance? The Commission has presented its plans to clamp down on so-called sweetheart tax deals between governments and multinationals. Brussels wants member states to share information about tax rulings. Well, as you know, the first weeks of Jean-Claude Juncker's presidency of the Commission were marred by the so-called LuxLeaks scandal, revelations about tax arrangements that Luxembourg had made under his premiership with a number of foreign companies. But Luxembourg is not alone. Ireland, the Netherlands, Belgium and some will say the United Kingdom have all been put under the spotlight. And in the second part of the show, I'll be joined by the Ukrainian Minister of the Economy. Despite the effects of the war, Aivaras Abramavicius wants to press ahead with ambitious economic reforms. Frank Engel, welcome to Talking Europe. You're a member of the European Parliament from Luxembourg. You belong to the centre-right European People's Party, that's the party of Jean-Claude Juncker. And you're a member of the Special Committee on Tax Rulings, among many things. Also with us, Philippe Lamberts. You're from Belgium. You're the co-chair of the group of the Greens in the European Parliament. And you're a member of the Committee on Economic and Monetary Affairs. Now, before we discuss this proposed directive, let's take a look at what Pierre Moscovici, the EU Commissioner for Economic and Financial Affairs, has presented this week.
Pierre Moscovici's tax transparency plan is en route. The EU's top financial affairs commissioner has got his eye on multinational firms, how and where they pay their taxes.
Our flagship proposal is about introducing an automatic exchange of information on tax rulings between EU member states.
Tax rulings are the deals made by governments and firms. Moscovici wants EU member states to tell each other about the tax rulings they've made every 3 months and retroactively over the last 10 years. The so-called LuxLeaks affair revealed over 340 multinationals had based their headquarters in Luxembourg to take advantage of tiny tax rates there, but that deprived other EU countries of tax revenues. The Commission's president, Jean-Claude Juncker, was Luxembourg's prime minister when many of the tax rulings were signed. Critics say Moscovici's plan doesn't go far enough.
The main shortcoming is that multinational companies won't have to report their turnover, their profits, their staff numbers, and the taxes they pay in each country that they operate in.
Luxembourg has warned the legislation will prompt multinationals to shift their headquarters out of Europe. Moscovici's plan is set to come into force on January 1st next year, if all 28 EU member states agree to it.
And the Commission hopes that the new rules will come into force by January 2016. There will still be hurdles on the way, of course, because it must be adopted by all EU member states. Frank Engel, does this go far enough?
That will entirely depend on your angle of looking at things. It is an exchange of information matter, just like we do exchange of information in terms of interest revenues. There should now be exchange of information on tax rulings that the states practice. Only multinational rulings, which is something that I find moderately strange, because this is obviously aimed at small member states such as my own, who do this sort of business. Whereas the bigger ones who do their own, or where even municipalities do rulings of rather significant dimension, would be totally left out of the picture. This is not something that I believe is very serious. And of course, no matter how far we go addressing the type of rulings that will be covered by this directive, it is going to be an exchange of information on the practice, which itself is going to continue. To what extent we're going to see. So it all depends on your angle of attack. If you want to do something against rulings, as some want, this will for them not be enough. If you want transparency of rulings, then this might be the road to take.
Philippe Lamberts.
No, I don't believe it's going far enough. I would agree with Frank that we should have, of course, exchange of information on all tax rulings. But then again, is only exchanging information. So the only result that you may expect from that is a form of peer pressure between member states not to abuse the system.
The name and shame principle.
Well, just amongst member states. I mean, this is not about public release of information. What I found really odd and to be completely honest, outrageous, is that the Commission failed to take the easy step, which was forcing all multinationals to disclose their main figures, and that is turnover, profit, taxes paid, number of people employed, and all the rest of this, country by country. This is a measure of transparency, which indeed is geared towards the wider public, and which indeed creates pressure on multinationals not to abuse the system. You know, when McDonald's was revealed to enjoy billions of revenue booked in the in the Grand Duchy of Luxembourg, on which they paid just crumbs of euros, and all this with 13 people employed, well, that's a kind of revelations that, of course, make their tax dodging practices visible, and they hate it. And the Commission failed to even propose this. So what's interesting is that they propose something that requires unanimous approval of the member states, which in other terms is far from done, and they failed to take the easy measure, which would put the onus on the multinationals and which would basically require a majority. So interestingly, the pro-business, pro-big business people in the European Commission and in member states are still very much around.
But this poses a major challenge to a number of countries, not least Luxembourg. We know that Luxembourg has signed a number of tax rulings with multinationals. Now your country will have to reveal the existence of those very rulings. Will it change anything?
No, because everything has already been revealed.
Yeah.
And it cannot be revealed any further. So-called British investigation journalists have seen to it that matters covered by tax secrecy are now in the public domain anyway. There is nothing else to be revealed. And there is nothing else that we could possibly reveal. Ours are now known. We can now look forward to getting the others to publish what they have in store. And I tell you, it's going to be highly rewarding, especially for those publics, English-speaking and the like, who have now been taking malignant pleasure at looking down at Luxembourg and thinking that all the crap comes from there.
You're pointing the finger at the United Kingdom?
I'm pointing the finger where it must be pointed. The United Kingdom and its multitude
of tax havens.
Of crown dependencies scattered all across the globe. Every single one of them a tax haven.
It is not by chance that the city is the largest financial center in Europe.
And three quarters of the liquidities that are sourced through the city every single day come from the crown dependencies. So where shall we look? Yeah,
here I totally agree with Frank, because, well, finger pointing at just one member state is totally dishonest. I mean, maybe per capita is Luxembourg the champion, but in terms of volume, we are not looking at the biggest...
This includes your country, Belgium.
Of course. And indeed, when we are talking about transparency...
quite a number of others. There are only 2 member states, that's Bulgaria and Greece, which don't at all practice.
Well, they have different practices probably.
Of course, but all the others do to various degrees.
Exactly.
And I would be highly interested, but that's for a next step. I'd be highly interested in looking at what Poland has done, what Slovakia has done, what other extremely low taxation level countries have done.
If this rule is adopted, we will get to know about.
No, because it's only about the rulings. And Belgium has different, well, does rulings as well, but Belgium has a number of other legal tax avoidance devices that are not part of the directive that the Commission has proposed. So basically, Luxembourg would have to disclose rulings, so would Belgium. But then again, arrangements, the excess profit rules that we have in Belgium, or the notional interests, well, Luxembourg would not have access to the information of what Belgium gives as advantages to multinationals operating, I mean, having a foothold in Belgium. And this is where, again, this falls utterly short.
Tax rulings are not illegal. They are perfectly legal, but
they may be legitimate.
But the problem is obviously the lack of transparency. The problem is the lack of transparency. Mr. Moscovici himself said that tolerance has reached rock bottom for companies that avoid paying their fair share of taxes. There is a moral question here. Let's go beyond this directive. Do you get the feeling that multinationals are starting to feel the pinch?
I hope they do. Because at the end of the day, I also belong to those who believe that it is not indefinitely tenable, that every single individual, that every single small company pays 20, 30, 40% of taxes on their income, and that those that are simply big enough to arrange themselves in such a way that they are not concerned by this can get away with single-digit percentage points, if at all. This is a really existing problem, as the Germans used to say in the former.
But everybody agrees with you, but then the member states have vested interest, and they will be reluctant.
So they do.
Is Luxembourg ready to put an end to this
This is not a question of Luxembourg, because believe me, the notional damage that has been done to the practice of rulings in Luxembourg already is such that I don't really contemplate a very, very bright future for a flourishing rulings business in that country. But for reasons of fairness, because after all we're discussing about Europe here and in Europe here, I would now be interested in what other countries do in order to attract businesses. Because at the end of the day, one of the things that Europe needs to continue to do and needs to continue to be able to do is to attract businesses, including business headquarters, to the EU. This is a capacity that we must retain, which means we are going to use in the future to achieve that. Is certainly up for debate.
Yeah, but then again,
if we relinquish this capacity, we're going to destroy the already crumbling European economy further.
But we should do that in a concerted and cooperative manner between European member states. Again,
absolutely.
It's about Europe. I mean, all of us competing against one another produces one set of victors, and these are the big, the shareholders of the big US, the big multinationals, be them European or whatever. If we want, all member states to have A, the income they need, and B, the economic activity they need, well, then we need a concerted approach. And there, to be honest, it's again a matter of fairness. I mean, absolutely. I hate it too that SMEs, of whom everyone is saying, well, these are the ones creating jobs, innovating, and all the rest of it, end up being the ones paying most of the corporate tax, of the business taxation, which is totally economically
and being on every single screen of every single state administration all the time, whereas all the others will always get away.
Absolutely.
This is something
but the problem is that
address.
tax rules remain a national competence.
Yes,
you're telling us we need to work together.
But there's another project coming from Europe, which is permanently blocked by the Council, so by the member states, and that's this idea of common consolidated corporate tax base, basically having one definition of profit, one only, because we have different definitions of profit, and allocating that profit among member states on an objective base, and that is that, well, you know, all this profit shifting between member states would have no reason of being, because basically we would say, okay, if you do 25% of your business in Germany, you pay 25% of your taxes on profit in Germany, and that's it.
We're still far from this corporate tax harmonization, though, at EU level, and that creates all sorts of problems.
I would not even be in favor of anything called harmonization, because harmonization to me always sounds like single rates, single system, all of that.
One size fits all.
I don't believe that would be beneficial. But I do agree, and the Luxembourgish government also, while it was led by Jean-Claude Juncker, always proposed that we need progress on a common approach towards the taxation of towards corporate taxation. It is not Luxembourg that blocked that. It is other countries that have been blocking that successfully, absolutely, for a very long time. And these are the fronts on which we now need to move. Yep. Because if we don't get to move on these fronts, all the rest is decoration.
Absolutely. Well, here again, I agree with.
Well, it's frightening almost.
Yeah. Well, I don't know. No, but we need to make progress on more cooperation. And again, if harmonization means one size fits all, I'm not in favor. But we really need a more concerted approach to corporate taxation. And again, it's also about rebalancing, because I personally would like to see the tax rate on SMEs go down. But if we do that, then we have to compensate. Because, well, we want to encourage people who start businesses, who really create value for society. And that means, well, going after those who exploit rents, and basically big multinationals increasingly are rent seekers.
We will also need at some point a debate about acceptable and reasonable levels of taxation. Everybody accepts that a quarter or so of what they produce can be taken away for purposes of common good. Let it be a third, and most of the people would still agree. If you exceed half, it starts becoming problematic, and this is one of the manifold reasons why people want to optimize their tax situation. We need to also address excessively high taxation in quite a number of places.
Are you referring to France, for instance?
I am, for instance, referring to France, because if France continues as it is going today, the only purpose that France is serving for itself, but sadly for parts of the European Union as well, is to drive business, innovation and investment away.
Now, the Commission wants that the new rules will come into force by January 2016, but before that it must be adopted, it must be ratified by every single member state. You were telling me that a number of countries, including the United Kingdom, were hiding behind Luxembourg. They may not like this new directive. Will they try to block it?
Well, it can go two ways. Well, either they will not block it, but then it will be because they will have found other ways to grant the same kind of advantages without being forced to disclose them to other member states, basically to circumvent.
Exclusively applies to rulings, so whatever is not technically a ruling is not covered here.
And that is the problem. That is really the problem. Because of the narrow approach that the Commission has taken, it opens the door to circumvention, and so they may be very nice to each other saying, well, we agree with the Commission proposal and so it passes, or they will find difficulties in circumventing it, and then they might be tempted to drag their feet. Because what the usual technique has been, remember offshore leaks? We have had LuxLeaks and now Swiss leaks. Once there's public indignation, many politicians want to be seen as doing something, but once the wave is over, once the indignation is over, well, we go back to business as usual. And I suspect a number of member states and a number of commissioners to just play with time and hope
commissioners coming from certain member states.
Frank Engel, Philippe Lambers, thank you very much for taking part in the first part of Talking Europe. Now, please stay with me. I'll return just after the news break. I'll bring you an interview with the Ukrainian Minister of the Economy. That's in about 10 minutes on France 24.